Hi, everyone. Welcome to today's webinar hosted by the DC Bar Pro Bono Center and provided by our team of real estate specialists from Transwestern. My name is Jason Q. I'm a managing attorney for nonprofit and small business legal assistance programs at the DC Bar Pro Bono Center. Here at the Pro Bono Center, we provide a range of services, including opportunities for brief legal advice via our online consultation services, and also training and education on nonprofit legal matters. So thank you for joining us today. A few housekeeping tips right off the top. If you look on your GoToWebinar client, for those joining us live, there is a handouts tab that has a place where you can download the presentation for today. And then also you'll see a questions tab where you as the audience can type in questions during the presentation. We're gonna save the audience questions for the end of the presentation. Unless the presenters, indicate otherwise. So keep them coming in and I'll keep an eye on the questions and I'll manage them as we're going through the presentation. Our presenters today from Transwestern are Stephen Powers, John Luger, and Aaron Karuzka. We are very happy to have them. I've dropped some presenter bios in the chat, and you've also seen presenter bios at the login page for the event, so if you want in-depth bio information. With that, I will pass it along to our presenters today. I think we're going to start off with Stephen.
All right, thanks so much. I'm thrilled to be here. I'm Stephen Powers. I'm the national head of Transwestern's nonprofit practice. And a big part of what we do is we try to be a resource to the nonprofit community, especially during these challenging times. All different types of nonprofits are dealing with occupancy issues. But one of the small silver linings is that a lot of nonprofits have varied funding streams, have a long history of operations, and while they've been negatively impacted in major ways, there's oftentimes an opportunity to have a bit more leverage than you might otherwise have in a real estate market. Across the country, the real estate market has been impacted dramatically. We're going to talk a little bit about that today, but essentially that's created a situation where nonprofits have potentially some leverage. So today we're going to talk about maximizing your COVID leverage. I've been doing nonprofit real estate for the past 15 years, working with a really wide range of nonprofits, and essentially, we're going to present some research and some data as well as some strategies on how you can use it. I'd like to introduce my colleague, John Luger.
Thank you, Stephen. Really appreciate that. My name is John Luger. First of all, I'd like to thank the DC Bar Pro Bono for this opportunity. We really appreciate it on behalf of our entire presenter team today. I'm the Executive Vice President for Tenant Advisory and Workplace Solutions in the Mid-Atlantic. I also co-lead our Mid-Atlantic nonprofit practice. I've been serving nonprofits and other tenants in the DMV, as we call it, DC, Maryland, and Virginia markets now for 16 years. Also uniquely, I'm the founder of the Luger Center, which is a nonprofit. We call it a do tank, which was founded 8 years ago. We're focused on bipartisan governance, global food security, and nuclear nonproliferation issues. So I have a pretty good grasp, not only as a real estate professional serving nonprofits, but also a practitioner within a nonprofit. So glad to be here today on this. So I thought what we would do, again, as Stephen mentioned, really the idea of today's webinar and workshop is to give you all the framework to think about your real estate issues and really what are unprecedented times. So the idea again is to give you some tools, some thoughts, and what have you, so you can develop a more analytical framework for making informed real estate decisions. So going on here to the next slide, we're going to look at sort of just the 35,000 foot view.
Sorry, John, before we get started, I did want to quickly introduce Aaron.
Okay.
And then go around the room virtually. Aaron, why don't you introduce yourself?
Sure. Good afternoon, everyone. I second John and Stephen here in thanking the DC Bar Pro Bono organization for letting us be a part of this conversation. I lead our workplace strategy strategy here at Transwestern, and my background is in workplace design. So I've actually spent 8 to 10 years working with law firms, nonprofits, tech firms on the design side of things before joining Transwestern to lead that conversation on the consulting angle. So I'll be speaking to you today a lot about navigating the remote work world, as well as a lot of the conversation around workplace design and culture, and even talking about decentralized and centralized office locations.
And normally when we have a group that's a bit smaller, we like to go around the room and ask everyone to introduce themselves and tell us what they're hoping to achieve. Due to the benefits of technology, we can. It'd be great if folks can in the questions box to let us know what you're hoping to achieve, and we can integrate some of those questions into the content as we're talking about it. So please send away so that we get a sense of what you're hoping to get out of today's workshop. But otherwise, John, take it away.
Okay, thank you. So anyway, back to, again, today's goals. We're going to start with sort of a 35,000-foot view of the Washington, D.C. area market. Give you a little update there, some of the things that we're seeing right now. So let me give you this first slide here. As you can see, in recent months, leasing transactions have fallen by almost 50%. Obviously, a lot of this is COVID related. But obviously, from your standpoint, this has meant that landlords now are hungry for deals. Leasing activity obviously is slowed down dramatically, and it creates opportunities for nonprofits, which we'll go into more detail throughout this presentation. So the bottom line, as we're looking at this, is obviously we have a very favorable tenant market that exists right now, and we expect it to get even more favorable next year and probably into 2022. As you'll see below here on the sublease space, one indicator of this is that you're starting to see the availability of sublease space begin to increase. Generally, over the past few months, these have been smaller blocks of space, so, approximately 5,000 square feet, both Class A and Class B. The Class A space has generally been lawful space on the market, and then some Class B, we're seeing some nonprofits do that as well. In recent weeks, though, we've noted that larger blocks have been coming onto the market. These have ranged anywhere from 12 to 36,000 square feet. So this trend is starting to accelerate. Again, what this basically means is that there's going to be increased competition for direct listings or direct space in the DMV markets. And of course, that's going to lead to increased opportunities and leverage for tenants and nonprofits in particular. Having said all that, market rents have held relatively steady thus far. But what landlords have done in order to incent tenants to transact is they're offering much higher concession packages, higher than probably anything we've ever seen, at least in my experience in the DC market. So again, what that is doing is it's increasing opportunities for creative deal structures with significant economic savings that could accrue to tenants, in particular nonprofits. Moving over to the unemployment scenario, obviously it's coming down, but it's still above pre-pandemic levels. What this does, I think, for nonprofits in particular that are thinking ahead is that it's going to create opportunities for talent acquisition, right? So that's one of the interesting silver linings potentially for nonprofits in this particular market environment. For those nonprofits that have thought about buying, sales volume in DC is absolutely just crashed. So it's not a good time to sell, but if you're in a position to buy, it's probably a great opportunity to buy. So the whole motto here, as it will be throughout our presentation today, is be prepared.
So as I mentioned, a big part of what we do in the nonprofit practice is trying to provide data to help inform decision making. And so we're going to talk about some benchmarking as well as what some trends we're seeing in the buildings that nonprofits occupy and how it compares to the rest of the marketplace. All right. So, one of the things that people throw around a lot is this sort of how much nonprofits spend on their real estate as a percentage of their overall budget. And, when, we've heard in different markets, people throw out 5%, they throw out 10%. But the true answer to that question is much more nuanced. And so, what we see in general is that large organizations that spend more than $10 million a year overall on their budget allocate less than 5%. So in DC, it's one of the lowest in the country. They allocate 4% of their budget towards real estate. Mid-sized nonprofits that have a budget of between 1 and 10 million allocate 8% on average towards their real estate. And then small nonprofits, that under $1 million that do have physical spaces that they rent, allocate a disproportionately high amount towards their real estate. And that's often because there's sort of a fixed expense scenario. And most nonprofits don't find themselves in a WeWork scenario. It just doesn't work. And so they end up allocating a lot more money towards their real estate than their larger counterparts. But the answer is a little bit more nuanced to that. And so, it also depends on the type of organization. So in general, nonprofits that spend money on their real estate that are public facing or that are client facing or that are venue dependent, so like theater organizations and cultural organizations, or groups that are having large convenings, spend a disproportionately high amount on their real estate than organizations that really just have central administrative offices and don't need to serve a large number of people from their spaces. In the DC area, what's unusual compared to other markets is that you all spend a lot more for the mutual membership and associations than your counterparts around the country. And that's partly because the nature of the DC market is that you're not just having those associations with office spaces, you're also serving their constituents. And so you end up spending a disproportionately large amount on your real estate. Whereas on the flip side of it, we oftentimes see that healthcare organizations spend a lot more. In the DC market, you actually spend less as a percentage to your counterparts around the country, in that there are more groups in the health sector that are just hospitals, but it can also be in health advocacy. It also differs when you look at it based upon how much money you all spend as a per employee. So one of the great things about nonprofit sector is there's so much transparency and great data out there, and that the amount of money that you spend per employee is up to $17,000 in education, and that's again because it's venue dependent. But you're also doing it in environment and animals, which is essentially, again, because of the nature of doing advocacy type work and needing to be in a certain geographic location, you're spending a higher amount per employee than some of your counterparts. And then, on the flip side of it, the public benefit organizations are spending the least. It's a pretty dramatic delta, across the spectrum. John, do you want to take over here?
Yeah, exactly. Thank you, Stephen. So again, within the framework that I was discussing earlier in the presentation, one of the analytics that we look at is what is a nonprofit's occupancy expense as a percentage of budget by submarket. So you'll see in this particular chart what may seem to be somewhat counterintuitive, that an East End tenant, one of the highest cost markets in submarkets in DC, would actually have a lower percentage of their budget going to real estate versus, for instance, somebody in the uptown market. So East End defined as between 3rd Street and 15th Streets, Mass Avenue and Constitution, if you all are familiar with the DC market. And then uptown, obviously running up the Connecticut 16th Street corridors. So anyway, so the point here is that downtown, in the East End submarket, for instance, these tend to be associations, other large established nonprofits that have a pretty significant revenue stream every year, versus uptown, where you'll see while the rents may be lower up there, you'll see the nonprofit organizations actually have to take more space because they're customer or more programmatic facing. So this is just an example. When you are thinking about your real estate, you will want to benchmark. Again, this is an important metric that we'll want to use to sort of determine where you are relative to your submarket and your peers. Moving on to the next slide here, we just always like to sort of define what is a nonprofit building. And obviously, it has to be professional. Let me just back up real quick. We track all the nonprofit buildings in DC. And so, we have the criteria for a nonprofit building across the various submarkets is relatively consistent. So anyway, what is a nonprofit building? Well, again, it could be Class A, Class B. It's professional. Obviously, depending on the submarket, the uptown, you'll see more B up there. East End, for instance, as I just mentioned, more A trophy type of properties. They tend to be affordable, as we'll see on a slide here in a minute. You tend to be $3 or $4 more affordable or lower than your core submarkets. This is typically because the building amenities for the larger core submarket tenants tend to be a little bit more elaborate. You see more, you'll see a mix of high-end associations, law firms, and what have you. And there tends to be a bigger demand for building amenities in those situations. Obviously, in order to serve your membership and your programmatic activities, it has to be friendly to both of those aspects. Accessible to public transportation, obviously, it's very key. And you'll see, at least in some markets in DC, the buildings will be accommodating to your branding needs. And then lastly, obviously, in this day and age, you need good security, but also you got to balance that out, obviously, with accessibility. So nonprofit buildings tend to check that box. So down below, one thing that should give everybody on this call solace is that landlords do value nonprofits highly. And one of the reasons for that is that because they tend to be longer term tenants, they tend to have been in existence longer. There are predictable rent streams that come from those tenancies. And what it does is it helps the landlords balance for-profit tenancies and buildings, which are a bit more irregular, shall we say, or inconsistent. And here, this slide sort of underscores that point. You can see here in the overall DC market, rents roughly $57.56 per square foot. This is all computed on a full service basis, versus the nonprofit buildings, which are generally, $3+ less per square foot. So again, and then in vacancy rates, this underscores again why landlords value nonprofits in their building. You can see here in the overall market, basically 12.4%, but those buildings that have significant nonprofit tenancy tend to have lower vacancy rates. So again, one of the things that you'll also note here in this first one, or I'd like to note, is that one of the reasons you see a gap as well is that trophy rents, these are sort of the high-end, newer generation buildings downtown and what have you. These are rents now that are well north of $80 a square foot. So that's also having a significant impact on this gap as well. On the next slide, this is another sort of benchmarking exercise that we go through with our nonprofit clients. And what you're seeing here right now is on the nonprofit building set, asking rent by submarket. What you can look at is you can sort of see, for instance, Capitol Hill, obviously at the top of the heap, tends to be a smaller market, but you have buildings like 101 Constitution, 300 New Jersey, what have you, that sort of drive these rents up. And so you can sort of go down through. But the point of this is, as you're thinking through your real estate needs going forward, this also provides a potential opportunity once you benchmark yourself to say, hey, look, there may be, especially for those folks that are coming into lease renewal cycles or have termination options or what have you, we could talk about that a little bit more, but it gives you the ability to sort of look around to the market, look at the programs or how your nonprofit operates and say, hey, look, you know, I'm at X, my real estate expenses are X right now, but I noted that maybe, you know, in this particular environment, I may be able to go to a more favorable submarket that would better support our programmatic needs of our nonprofit. So that's the idea here is that this sort of starts to tease out potential relocation opportunities for nonprofits. So again, this is one of these metrics that we like to use as we build a framework for your real estate decisions.
All right, so now the moment we've been waiting for. How do you take advantage of these favorable conditions that we were just talking about? And there's, you know, the goal here is to give you some tools that you can start to use, you know, right away to be able to, one, think about planning for your real estate strategy, but also setting the right expectations and then being able to then go ahead and use that to set yourself up for long-term sustainable economics moving forward. You know, they always say that in the big downturns is when, you know, fortunes are made, but it's also when you can take advantage of these opportunities. And so we're going to talk about a couple ways to do that. So first off, you know, we want to talk about if you have leverage, and essentially there's three components that make up your leverage in the current marketplace. One is you have to have some clarity as to where you need to be in 3 to 5 years. You know, a lot of organizations, especially for-profit organizations, are sort of saying we don't have that clarity and that they're being reactive to the marketplace. And so they can't really say where they're going to be, you know, a year from now. So they're hitting pause. But if you have a pretty good sense of that you're going to need to be in operations, that you're going to be growing or shrinking, but that what your needs are going to be 3 to 5 years out, that gives you the ability to engage in the marketplace in a meaningful way. On top of that, if you have a long history of operations, multiple funding sources, and potentially assets, you know, unrestricted net assets in the bank, that provides stability and creditworthiness. So, you know, we're not talking about being a traditional Fortune 100, you know, credit tenant. A lot of times nonprofits have stronger credit than would otherwise be seen on their balance sheet because of the confluence of those three things. And in the buildings where landlords appreciate nonprofit tenancy, they understand that creditworthiness. And finally, term. You know, if you're coming up towards the end of your lease and have, you know, less than 5 years on your term, it's an opportunity to start to renegotiate with the landlord to be able to say that, you have the credible threat that you're going to be leaving. But on the flip side of it, if you have a lot of term left, and we're working with an organization now that has 14 years left on their lease. They signed a lease just before COVID, and we were able to help them approach their landlord and say, you know, we are unable to pay rent at these levels, and that we need to figure out a way to recast our lease so that we can make it more sustainable. So really, on both sides of the spectrum, there's a lot of opportunity, and the combination of all three of these things gives you a lot of leverage. So the way that you use that leverage differs by the type of ownership. So there's a lot of different types of ownership, but for the purposes of this conversation, we broke it down into two categories. There's the REIT or private equity landlords. So those are the landlords that, you know, have shareholders or have required returns they need to hit. Oftentimes, when they buy a building, they need to sell it 3 to 5 years out in the future and hit a certain level of return. And for those types of ownerships, what they really care about is the face rent. So face rent is the number that it says we're paying $68 a foot. But behind face rent are things like free rent and concession packages where the landlord can pay for the build out, can even pay for some of the soft costs, as well as sometimes in certain circumstances, we've even gotten them to pay for furniture. For a lot of the schools we work with, we get everything included. And so in those scenarios, the landlord might be willing to agree in return for a higher face rent to give you a huge concession package and then to spread it out over years, so that at the time that they're looking to sell in year 4, you're paying a high rent, but that in reality you're actually paying a much lower rent when you have your free rent period spread out, you know, during those first 4 years of your lease, for example. And then on the flip side of it is things family and private ownership. So there's a lot of landlords whose families own buildings, and there's a lot of people a lot of mouths to feed, and they come to rely on that income. And so they really just want stability. And a lot of those are these favorable nonprofit buildings that have landlords that appreciate that tenancy. And those are the ones that have immediately started making reductions. And so, while the public asking rents haven't gone down, we're seeing in these types of buildings that they're willing to immediately meet the market in order to do deals, and they're willing to do rents 20% lower than what they were before the pandemic. And so these are people who are going to immediately have lower face rents and favor longer term deals with stable tenants. On top of that, there's overall some advanced leverage techniques that we want to sort of empower you with. So based upon your current situation, you have the ability to take advantage of different things. The first is if you have a long-term need. So if you've been around for many years and you know where you're going to be, and you have a level of certainty as to the amount of space you're going to need, or at least the trajectory of space over time, even if you're in growth or contraction mode, being able to make a long-term commitment allows you to essentially lock in below market rents now. So, landlords don't like to hear this, but what happens is you're able to establish a lower rent. So, for example, if you have you're 3 years on your lease and you extend your term for another 7 years, you might be able to get an immediate reduction in rent, 20% less, meeting the market, and lock that in so that it escalates based upon that new lower number. As we talked about credit before, if you have especially strong credit, so foundations, sometimes associations with long histories and endowments, you have the ability for landlords to provide huge concession packages. So we talk about concession packages, that's things like tenant improvement allowance, some money the landlord is going to give you towards your build out and associated expenses. The free rent period for a long-term deal, we're seeing free rents in excess of a year. And sometimes, we're talking about a case study where we got much more than that in terms of free rent in this current environment. And even in certain circumstances, you're in a building that you don't want to be in anymore, and a landlord wants to lure you in. In addition to this, they're sometimes willing to even buy you out of your existing lease with your landlord, take over the hassle associated with that. So all three of those things together can add up to concession packages worth more than 3 years of rent, which is truly incredible. Dedicated entrance needs. So, a lot of nonprofits directly serve the public or have an interest in having a dedicated entrance from a branding perspective and from a curating the environment for their clients that they're serving. But oftentimes ground floor space comes at a premium because you're competing against retail. Well, I don't have to tell you all that the retail marketplace has been decimated, even pre-COVID. But now, with all the closures and forced shutdowns, retail has really been hit hard, and rents have come down substantially. And in return for being able to get a tenant to be in the building, we're oftentimes able to get them to throw in the dedicated space at no premium. We're working on a deal right now with a large social service agency, and essentially we're getting 11,000 square feet on the ground floor at the same rent as what we're getting on the above ground space. So pre-pandemic, the space was $150 a foot, and we're getting it for $36 a foot on the ground floor as a way to make this deal happen. And then the next is flexibility. So, flexibility is extremely valuable to an organization. It's not just about dollars per square foot. If you don't need the space, if you would like the ability to contract, as well as the ability to expand, we can build that in and again, not have to pay for it. So we're working on a deal where we help Goodwill in one of the markets negotiate that they can give back up to 5,000 square feet of space at any time during the next 3 years at no cost. We also are working on a project where the nonprofit knows they potentially want to take up to 15,000 more space, and we're getting the landlord to agree to keep it off the market so that we can take that space at no cost at any time over the next 3 years. So those are incredible opportunities to have flexibility and not have to pay for it. And then finally, if you're currently in a situation where you're above market on the rent, so you're looking at that sheet that what you're paying is higher than what you should be, you can approach your landlord now and get them to reduce the rent, sort of have it beat the market in return for extending the term. So those are, that's something that a lot of organizations are coming to us now, and we're able to sort of get landlords to recast their deals as a way to keep their tenants happy. But it's not about any one of these things, it's about packaging it together. So, the idea is to use all the levers available to you and then to package it together to create a long-term sustainable real estate strategy that's in alignment with your mission and sustainable for the future. And one of the things that we're seeing, in addition to what we talked about before, is the potential of getting lease to own options, or the potential to own property that otherwise wouldn't have been for sale, and that can help you take advantage of your real estate tax exempt status, so that about 20 to 25% of your rent is actually real estate taxes. And if you were to find a way to have an ownership structure, and have a debt scenario that mirrors what a rent scenario would be given the current environment, ownership might save you a lot of money. So before we get into some of the tools, we wanted to give you an example of a case study that's happening right now live in your marketplace. John?
Yeah, thank you, Stephen. So this particular case study revolves around a client of ours that was in the Bethesda submarket that wanted to look at a more core DC location, primarily to attract talent for its programmatic activities. So what we did for them is we used several analytical tools. Some of these we'll talk about here in a minute, but things like location and commute analysis. We did some labor analytics and drive time analyses for them as well. And so what we did is, Transwestern provided strategic planning sessions with key stakeholders to sort of figure out exactly what their objectives were. I just mentioned the primary one. And through our consultation with them and using our analytic tools, we're able to find a location in the DC market. Let me just, can we go back to that slide real quick? Build a case study. Okay. So we're able, through these various techniques and also looking at their objectives, to basically leverage what's a pretty soft market right now in the central business district of DC. This included a pretty dramatic concession package, which allowed for greater rent relief and a positive impact on gap accounting. Essentially, we spread the free rent over the term, which obviously helps from a gap standpoint. And then again, the primary objective was selecting a location that would help with their recruiting and retention for their DC employees. Finally, this building has the landlord actually has their own co-working space in this particular building, and we're able to negotiate in discounted terms on that co-working space over the term of the lease. So it gives our client the ability to expand and contract, in this case, probably expand at their leisure. So anyway, this is a good example, again, going back to the slides where we talked about, relocation opportunities into more ideal submarkets. This one sort of checks that box.
Before we dive into this next series of content, I want to mention, please do consider us a resource of information when it comes to workplace research and data as you help navigate decisions around this topic, as we are helping many of our clients with this conversation, each of who are in a different position. Secondly, you're going to see some stats throughout this next series from a source called Global Workplace Analytics, which is really a great go-to global resource for data on the topic of workplace. Okay, so anytime I'm leading a conversation around workplace, I like to remind the audience of the fundamental definition of workplace, because it is a rather universal one that even through everything that has happened in 2020, it is still one that holds true. The definition of workplace: any space that generates value for a business is a workplace, and the nature of that environment shapes the experiences of the people who use it. So is it important to know that while there are informed trends that we are seeing, there really is no one-size-fits-all solution, but more so this understanding that each company and organization is an ecosystem of different needs, and a hyper-focus on those needs is what is becoming increasingly essential. So I'd like to start by first taking a step back. Here, remote work. It's always been here, right? we've been analyzing how remote work was or was not present in our organizations throughout this past year. So we're kind of working to define which camp do we fall into. Are we office first organizations with next to no remote? Were we office first with some hybrid remote work? Were we on the flip side remote first with a little bit of office? Or were we really remote first with next to no office? Each of these has existed pre-pandemic, but really it was that last category, that remote first, no office, that tended to really just fall into really, really progressive companies. But now there's a lot of other organizations out there who are questioning if that is the camp they will fall into in the future. So pre-COVID, less than 5%, this first stat here, of the workforce was working remotely half of the time. Yet 56% held a job that is compatible with remote working. So fundamentally, those are a little bit at odds with each other. But it's a hyper focus on statistics such as these that's really has drawn into question why the office exists and what's the purpose of our large centralized office location, because the large scale compatibility with remote work has become a reality. As we emerge from the COVID-19 pandemic, it's going to be all about creating a new purpose for the office that's centered around delivering a unique experience, one that's going to support our staff both in person and virtually. So really this idea of the third place comes into mind. These are the locations where we exchange ideas, have a good time, build relationships. And for some organizations out there, potentially just depending on job functions and roles, that third place might become the office. And so effectively cutting out this one in the middle. So that's to my point of, each organization is very different, and it's a hyper focus on those needs that has become very evident. Is remote work here to stay? I mean, this debate has been going on for several months now. And what is great is that we've been able to start to fill in this last category here the longer that this pandemic has gone on, because we have a little bit more data, research, and conversation to tap into. But effectively, what we have seen is an acceleration of trends that we've already been researching over the last decade. So that's given a lot of peace to a lot of workplace designers, is that we already have a head start to a lot of these topics. That I want to point out one statistic here on this page, which is that lower left desk vacancy number. Effectively, this has risen faster than it has ever risen before this year. And employees are realizing firsthand, and not at a hypothetical conversational level, that increased choice and variety correlates to their satisfaction and potentially their workplace effectiveness. So it's the sense that this hybrid arrangement is providing a greater work-life balance and supports productivity. During the pandemic, we started to see that conversation around the future of workplace being much more about more remote. And also we started to see this reduction in fear around our employees are working. We're effectively forced to figure that out and to navigate around that. Now, shifting forward, I'm going to highlight this one statistic here. 75% of people are the same or more productive in COVID. I'm going to put a little asterisk here, because productivity is obviously relative. But there's some conversation around, why are we seeing these high numbers right here? And there is a notion that potentially we're working off of a built-up supply of social capital and, cultural cohesion that we've been building up over the last several years. For the last decade, we've been sort of inundated with, making more social and culturally stable workplaces. So there's a question out there, are we operating off of a bank of social capital? And if that erodes or starts to disappear, will we have issues with long-term talent retention? But we'll discuss that a little bit further. Here is one case study that was actually done with Global Workplace Analytics, completed with the U.S. Senate Committee on Environmental and Public Works, which was done across 8 agencies. And we included this case study because it's really, really important to look at both sides of the equation. The one being looking at your real estate savings. So there's significant savings when it comes to talking about remote work. but it's uber critical that we start to pair that up with some of the more qualitative aspects, which are around employee sentiment. So these two metrics are just as important, while one is financially motivated and one is talent motivated. And we're going to talk a lot about that war for talent, and this side of the equation is just as important. For the next series here of content, we wanted to put forth the wide range of challenges that organizations are working across. And each organization has probably prioritizes these a little bit differently, but I think it's really important to see that spectrum so that we can understand how large this conversation is and really start to hyper-focus on the one that is most important to your organization. Financial impacts. There's a sizable impact from a taxable benefit perspective with regards to remote work. And there's an evolving conversation in Congress about this. What happens when your employees don't live in a critical mass, for example? Or, how are they going to get taxed? Or how do you think about it from a benefits or incentives perspective? Office footprint here. What's the right size for your workforce? And how should it be designed? Those are really challenging conversations. And we'll go into depth here in a little bit. The war for talent. While there's been some disruption to the workplace, that war for talent is continuing on. And like I mentioned before, employees are realizing the benefits of no commute and more flexibility because it's been a reality, not that hypothetical topic. So what about, my workspace is going to excite me? The quality of that workplace will still be a differentiating factor between organizations. What's that first impression of your company, and what is that recruit going to see on day one? The second to last one here, cybersecurity. How are you protecting your organization's content, or more importantly, your client's content? What is even down to, things like what's the financial impact of buying tech for all of your employees at home? Or should I say maybe keeping up that investment over time? And the last one here is actually a little bit different in the sense that it is more landlord focused. What amenities should buildings be offering? Effectively, could your real estate do more than it historically has? I love this phrase that has emerged, which is escaping home to enhance your work. We're looking at, on the landlord side, more intentional amenities, things like a podcast studio, an idea lab, a print center, a feeder, whatever ones might be applicable to your particular organization could be interesting. What do your employees need to get their specific tasks done? What spaces? And on some of the more intangible things, a lot of us are used to seeing that on-site fitness center, but are there virtual fitness benefits? Subsidized commuting? Are there product partnerships and discounts? So effectively, could our real estate be doing more? So what I like to say here now is, we've effectively shifted from no longer returning to normal, right? There was this phrase that was like, let's just get back to normal. What's back to normal? But I think now we've established new behaviors, right? We've been in this for long enough that if to go back to normal, we are going to have to break those new behaviors, or we're going to have to integrate or pivot from them. So effectively, that really does mean bringing in the hybrid model. And I like to use, if you're looking for a specific framework out there to have these conversations about how to move forward with your office, I do like the words, which I call the 3 C's: culture, collaboration, and communication. And to use that framework, culture, collaboration, communication, for a lot of decisions moving forward, I think it's a great organizing mechanism. But let's talk about real quickly. I want to just get sort of really specific here because I think that's a little bit helpful on 3 areas. Office design. There's obviously some short-term considerations like safety, security, building confidence around your employees getting back to work, virtual conferencing capabilities, having every tech, every space tech enabled. Those are kind of short-term. But on the longer term, there's a conversation around changing that evaluation metric. A lot of us are familiar with looking at, things like workplace density, square foot per person. And now there's been a shift to looking at how employees find value in the time that they spend there. That is the most important measure of evaluating space. So, we're effectively used to planning our workspace around, I guess it's like kind of the X, Y, and Z, who's the left, to the right, and above us in our space. But now we're introducing this 4th dimension, which is time. How effective can folks be if they're coming into the office for a select amount of time? The next two parts of design I just want to highlight here actually take a lot of cues from retail design. Think about that industry, and it's historically had the challenge of bringing folks back to the retail store over and over and over again. And there's a lot to be learned there. So the first one being that entry experience. I just cannot emphasize this enough. How a retailer greets a customer influences them so much on an emotional level. It's like how you feel when you walk into that space. I'm sure we've all kind of walked right into a store and like immediately turned around because we're like, this is not our vibe. This is not what, like, they're definitely not selling something I'm going to be interested in. Or we wait for our husband or our wife to come back out, or our friend, whatever. So it really is important to look at that entry experience. It's really your first opportunity to create a powerful statement that reminds employees or recruits why they are going to be there. And then the last one I like to call spotlighted experiences, because I think it's something you can also relate to on the retail side of things, which is those rewards and happy moments, right? It's walking through that retail store where they're doing a product demo, where it's the coupon kiosk, things like those surprise and delight moments. And on the workplace side, that's, those alluring, engaging spaces like cappuccino bars, wellness spaces, lounge. Those are just sort of a few examples, but finding out what ones make sense for your organization.
And one of the things we're hearing around the country is that people are throwing around the term the office as a collaboration hub or the office as a culture hub. Are you seeing that as well?
Right, exactly. Yep. Doubling down on that word culture, which we're going to get into in a slide here. So, and then these next two are pretty quick. Operation. So, there's a ton of information on the office design side, and it's actually quite exciting. On the operations side of things, what are we talking about here? This is a little more tactical, based on schedules of who are coming in and who is not coming in. And a lot of you might have had experience with the group A, might have experimented with a group A and a group B this year, and that may have worked out great and may not have. But longer term, it's about aligning office visits to function and activity. So for example, a new hire might want to be in the office for a majority of their time for the first 6 months for onboarding, just to kind of soak up that culture, build up that bucket of social capital that we were talking about. Or maybe a seasonal employee might come into the office just mostly during peak periods, right? So that's sort of the longer term operational impact versus, something that we've seen this year, which is, group A, group B. On the people, on the IQ and EQ side, we just can't hammer home enough that war for talent. And the biggest topic here under the people, IQ and EQ, is making sure that we are putting forth mechanisms to keep everyone connected. And that's extremely challenging, but there are ways of which we can move forward with that. So you heard Stephen, mention that word culture. It's part of that 3 C's, that framework. And there's a great little analogy here, which is the iceberg analogy, which is often used for a lot of different things, but it applies here for culture, which is 20% of that culture is what you see. It's what you hear. It's what's stated, right? It's on your website. It's, it's the contribution to the community, things like that. But it's 80%, which is what's happening below the water, right? Which is like the water cooler conversations, those impromptu laughs, the celebrations, the high fives, the overhearing of that joke or the weekend conversation and chiming in. People miss people, and that has been sort of one of those things that is that 80% number that we're missing out, which has been extremely difficult to replicate on a virtual basis. So even though, you've seen a lot of those major tech firms out there suggest that employees can work home from permanently if they wish, again, it gets back to, are we just running off of previously built up social capital? And it's a particular concern for young people and organizations who do not have that capital yet. Communication is key. Standardizing meeting culture. What I like about this is it's an interesting new conversation. Establishing rules around what requires a meeting, maybe length of meetings, video meetings, phone meetings. That is something that is very unique to your organization that could be a way to think about how that influences your culture. Surprise and delight. We're used to bringing the cupcakes to the pantry to celebrate the birthday. How are we going to surprise, folks who are working remotely? Instant communication tools. There's definitely a lot of conversation out there about email fatigue. So how do we, use some other platforms for that quick hits of info? And then soliciting and using feedback. Continue that feedback chain of information because it's very important as you move forward in these decisions. Steven,
Great.
you want me to kick it back to you guys? Yep.
Yeah, thank you so much. Really appreciate that, Erin. So I know we've thrown a lot at you all today, but you know, given where we are, December 2020, and what looks like a very favorable market for tenants moving forward into 21 and 22, I think it behooves, we tell our clients this, behooves you to really put together a smart plan for the post-COVID market. It's really an opportune time to develop, your real estate strategy, to think through these things, and to leverage emerging opportunities as they present themselves. This is especially true, again, if you're entering into a renewal window or have favorable termination or expansion options in your lease. So this timeline sort of shows you, unlike other things other services that you purchase, doing a real estate transaction is not something that can happen overnight. Obviously, there could be some tweaks and what have you to existing leases and what have you. But in terms of and your needs assessment and the acquisition timeline for transacting, this gives you a pretty good idea that it's typically a relatively long process. So, but the good news is the silver lining again is that you have some time to really think through the issues that impact your organization, and then translate that into your real estate needs. One of the ways that we do that, moving to the next slide, is more tools here, but more analytical tools. These are some of the things that we do in terms of mobility and movement, for instance, demand analysis, commute analysis, intraday travel analysis. Again, the idea is that these are tools that we deploy to facilitate the overall acquisition timeline that I just described.
Hey, John, on that front, on the intraday travel analysis, this is an example from a social service agency that had multiple locations around the city, and they were thinking, currently they had one centralized training center, and we looked at the potential of having, instead of one centralized training center, having two that were close to their two service hubs. And by doing that, we were able to calculate the amount of time saved, overall for the organization. And we quantified that it added up to literally saving the value of 15 full-time employees by having a second training center closer to the other service hub. So these are the kind of things that you can take a gut reaction and then turn it into a reality. Same with the commute. People always think that they know, but it's really important to test those assumptions, as well as the populations that you serve, really to know where they are instead of just sort of, hey, this is how we're feeling about it. So that's really what John's talking about, is giving you the data to make informed decisions.
Great. So when we start looking at the size of footprint and mobility, we look at this term called utilization rates, which is how people are coming, how long they're staying, which spaces are they using to inform a space planning program. Is most of your staff off-site for most of the day and only coming into the office for administrative work? And how much space do they really need for those administrative tasks? So again, this kind of gets back to every organization's a little bit different, but that framework for evaluating it is the same. So a hyper focus on that utilization is important. And sharing ratio. This is not physically about 2 to 3 people sitting at the same desk at the same time, but looking at your peak capacity and planning around that. So for example, you may have 100 desks where 30% of your staff is usually out of the office. So you may really only need 70 desks to accommodate your peak occupancy, right? So there is a footprint adjustment, a real estate footprint adjustment around that. And there is, still some concern, right, around sharing and cleanliness, but I think there's a general notion that a lot of those challenges are easy to be solved. But the cost savings from reducing your real estate footprint is real. And another way to think about this is it could be a part of your growth strategy. So if it's a little too progressive of a topic on day one, it could be a way to think about absorption or growth, the sharing ratio as part of that absorption or growth for employees in the future, and not really that day one, because it can be a little bit challenging organizationally and culturally to implement this on day one. And then on this idea of multi-site real estate strategies. This has really effectively called into question the purpose of the large centralized office. So there's been 3 categories here that have emerged, I would say, as prominent. This idea of the centralized, which is effectively called the hub and spoke model. You'll see that in press and whatnot. It's visually represented as such, as you can see. And it's effectively a large centralized headquarters, but distributed satellite offices to get their workforce potentially closer to the place of residence, their place of doing business. And the HQ is a little more focused on bringing everyone together. So this can offer, more options where people can work in the event of disruptions like a natural disaster, power outage, major traffic disruptions, things like that. Or like I said, from a business development perspective, it can bring your organization closer to your clients or customers. Some large financial services companies, like one example is Capital One in New York. They actually located in a specific area to help foster connections with a nearby tech community, right? So it's not necessarily about getting folks close to their home or close to where they do business, but close to somewhere where they can attract talent. The decentralized notion, the second one here in the middle, this is effectively that centralized model is replicated in separate locations. So there's no really defined headquarters, but each office operates independently with a fair amount of equity. So that's a cultural conversation. And then each office has their own guiding principles and practices based on sort of the local vibe and players at that particular office. It can be ideal for a very widely distributed employee base. The distributed model, there's a lot of evolution and conversation around this right now. It's where brand, culture, values, they're replicated at all locations with a fair level of equity. It ensures a level of continuity and removes any sense of isolation from one office, that there's a preference to be at any office. It can be deemed a little bit redundant by some, but it does allow for maximum agility when it comes to physical footprint, because each office is effectively a replication or an identical twin.
Hey, Erin, can I butt in for 1 second? This is Jason from the Pro Bono Center.
Yep.
Sure. As we're coming up to the hour, for folks who do have to jump off at this point, I know we have a little bit more content and then audience questions. I just want to let people know that we'll be sharing a recording of the presentation with everyone who registered, so you'll be able to catch up if you do have to jump off now. Thanks.
So one of the things that is great about using this data to think about your growth is that we can run some models to figure out what we're going to be in the future, as well as thinking through scenarios with higher levels of space sharing or to accommodate that growth. And so, if we do that properly, we can also line up the strategy with the landlord so that if you have an option for expansion or contraction, it can line up with the timelines here. And this is really important. A lot of what we do for nonprofits is to give them the information to then be able to present to their board to build consensus. And so things like this help the boards. It's wonderful that you have 25 divergent opinions, but we need to manage that, as I'm sure a lot of you can relate to. So our job is to make it really clear that we've done all the work, and then to help them choose the right path forward after you've presented the data in a clean, succinct way. So we'd love to open this up for questions. Some of you have asked a number of questions during the workshop, but please let us know, and then Jason's gonna read out loud some of the questions that were asked.
Yeah, fantastic. Thank you so much. I'll start with kind of a recent one, and this might open a can of worms, so we don't have to get super deep into it. But one of the attendees noticed that this shift to remote work might have some implications, and this was touched on in one of the slides, might have some implications on employment law coverage and sort of the jurisdiction in which our employees are located. Is there work that you've done on that issue about helping employers figure out the ramifications of that shift? And are there some like high-level insights or observations that you've come away with on that issue?
Well, you're asking. So we always tell folks that, know your role. So as a real estate advisor, we know enough to be dangerous, but we always say, hey, talk to an employment lawyer on some of those topics. and it varies, but essentially, the conversation is around how much time is spent in a given location, and if you're going to cross that threshold, you want to be cognizant of it. So you should talk to if you are planning on having a lot of remote working and even doing it around the country, you want to get that information from your attorneys on that topic, so that they can make a decision and understand the potential impacts to them and how they're going to have to navigate those waters. It can be very complicated if you're trying to maximize from a tax perspective, and so, but a lot of our nonprofit employees are less concerned about that than some of the private equity players that might be otherwise hyper concerned about that topic.
Yeah, great. And I'll mention that if people do have specific employment law questions, they can always come back to us at the DC Bar Pro Bono Center. We have consultation services and other resources that you can use to help figure out the ramifications of multi-jurisdictional employees. So this is almost like a mini case study from one of the attendees, and maybe we can expand on it. But she's asking, if we know that we're not likely to stay past the end of our current lease, which is in March 2021, would that be enough to exercise some leverage on our landlord to have them reduce the rent? Is that a conversation they should be having now?
So, March 2021 is really soon. So you only have a couple of months left. If you've already identified where you're going to relocate, that's sort of the most important threshold question here, because if you are planning on moving, then you really need to make sure that on the flip side of that is where you get the leverage of getting the proper amount of free rent and the ability to cover the costs associated with moving. If you're planning on essentially shutting down and going remote until you know when you're going to be back in the office, then really the conversation is with your landlord, not about essentially giving you a reduction to keep you, but essentially that you can make the claim that you're unable to afford it and that you need to have some free rent. So it's a nuanced conversation, and please reach out to us so that we can better understand your objectives and then figure out the best way to solve for it.
Great, thanks. And that sort of dovetails well with another question, generally about timing, asking, when would be a good time to start thinking about negotiating a new lease, possibly in new office space, triangulating, I guess, with the fact that folks don't want to go back into the office until maybe a post-vaccine kind of more return to normal kind of environment. Do you have any advice for that?
John, why don't you take this one?
Yeah, I would say that, again, using some of the tools that we've outlined today, some of the concepts, just to have a general sense of, again, defining what your requirements are. This is a great time to do that. And obviously, the vaccine rollout, it started in the UK, I guess 2 days ago, and knock on wood, hopefully we'll start to see the rollout here in the United States, North America in the next few days. So as that unfolds, I think it's a great opportunity to really sit down and understand what your needs are going to look like, post-COVID, obviously with the vaccine arriving. So again, if going back to the timeline that we described, it tends to be a relatively long process. Obviously, you need to work back from your lease X date. And of course, that all depends too if you're planning on staying in your existing space or you're looking at other opportunities. And obviously, we help our clients evaluate those situations on a daily basis.
And, one of the things that we always tell folks is that when you approach your landlord, you want to have a credible threat that you could leave. So in order to have that credible threat, you need 12 to 18 months. We prefer 18 months. And before you reach out to your landlord with that credible threat, you actually want to know what you want to do. So you want to know if it makes sense for you to stay or if it makes sense for you to extend or contract or move. And so that planning work needs to be done in advance of that. But that's that's the optimal leverage point, so that if you have a credible threat to leave.
Yeah. I mean, again, on that point, there are ways to compress this timeline, but I think, prudence always dictates that you really, as Stephen said, that you really have your ducks in a row before you approach the landlord. Again, information is key. It's the strategic sort of weapon that you need in order to have an effective conversation and negotiation with your current landlord and others for that matter.
Awesome, thank you. Someone's asking, do these same negotiation rules and concepts apply to those who are working in co-working spaces? Do the same kind of leverage exist?
The co-working environment they've been devastated. It's terrible. I feel, not that we feel bad for, some of the folks that we work who had bad behavior in the past, but when you go to look at some of these co-working spaces, they're completely vacant. And they're actually offering, we get landlords that let us know, hey, if you have any clients that you want to allow them free access to our space, we're willing to do that. So the leverage in the co-working environment is extremely strong. You can get them to give you a number of months of free rent in return for any kind of commitment. They're really looking for bodies so that when people come in, it doesn't feel so desolate. So they pull aside, and we had a client that needed that, a nonprofit that was transitioning to co-working during COVID so that they could reduce their expenses, but still needed a physical footprint. And we were sort of, they had their party line as to what the rent was supposed to be, and then they pulled me aside and was like, but seriously, anything, let us know. So the answer to your question is absolutely.
Yeah, and let me add to that, Stephen, if you don't mind. What we're seeing right now is we're getting a lot of calls from folks that are in co-working spaces asking us about sublease opportunities. As I mentioned earlier in the presentation, there's a lot of sublease space coming onto the market, and depending on the size of your co-working situation, there could be really interesting short-term, almost like co-working opportunities out there in the subleasing market that you may want to explore. So it's just another idea.
Yeah, and we actually were able to, in that scenario, because there were so many compelling subleases out there, we were able to get a lot more value in that space. So, great point, John.
Great, that's awesome to hear. Another option for folks. Someone is asking, speaking of concession packages that they can try to negotiate, could it possibly include paying for storage if an organization has an opportunity to move out of one space, but it's going to take some time for them to fully build out and transition into the new space during that kind of in-between period, covering like storage or other costs that might be associated with that?
I would say that typically what we try to do, I'm just talking about Transwestern in DC, we have a construction management group that we really are fully integrated with that can help think through those issues. So what we try to do is avoid situations where you need swing space or storage opportunities. But once again, given what's going on in the market right now, with whether it's sublease space, some buildings, have storage opportunities that you can take advantage of, but that's really on a case-by-case basis. But the point is that yes, we can structure a deal to give the nonprofit client that flexibility. Typically, what we like to do those throughout the planning process is that you turn off the lights in one location, there's a move, and you're flipping them on. So you move out on a Friday, you're flipping your lights on a Monday over a weekend. So, but the answer is yes. I mean, anything's possible. I mean, I think maybe the overarching takeaway from this presentation today is because of the crisis that we're in right now and its impact on the real estate industry, almost anything's possible in terms of deal structuring. I think, Stephen, you would agree with that.
100%.
Great, awesome. Another question that I hear a lot is for folks who really do need to move out of their current space, whether that's because they have to save money because they're also experiencing some financial ramifications from COVID, or maybe there's just something about the space that's really not working for them. What kind of leverage do they have against their existing landlord during that kind of exit or termination negotiation? My sense is that existing landlords are going to try really hard to hold on to the tenants they have right now. Stephen mentioned, for example, that some new landlords might be willing to cover the cost of buying you out of your current lease. Are there other strategies or concepts or tips around that?
Just that, if you're planning on moving out, it depends on when that is. So, one of the things that we can do to create leverage, as John mentioned, information is key. So the landlord doesn't know your situation. So, one of the approaches can be that we're trying to figure out a way to stay, to get the landlord to offer you some short-term incentives. We don't want to be dishonest or intellectually dishonest on that, but it's all about how you frame the conversation. If there is a glimmer of chance that they could keep you by giving you a couple of months of free rent now, they're willing to have that conversation.
Great, thanks. And this is flipping the analysis a little bit, but someone has asked, for nonprofits who do own their own building, how much of values fall in our area, and how bad of a time really is it to sell? You mentioned up front that it's not a great time to sell. Could you get a little more detail about that?
Well, I would say in the DC market, we're actually representing a couple of tenants right now that are leasing space, that are looking at purchase opportunities. And, it just depends on what submarket you're in DC, honestly. For instance, one of the clients is looking at Capitol Hill. That's traditionally and still is a pretty tight market up there. The owners are not really willing to drop, the purchase price on some of these properties. Whereas in other areas along Embassy Row, Uptown, in that area, yeah, you see folks that really came in on a more speculative basis, that now own the real estate. In some cases, the buildings are losing tenants, and they're in a sort of a different situation. So I think, again, in terms of somebody that wants to sell, an owner that wants to sell their building, location still is key. It always has been in real estate. We're seeing some activity. I'm just giving you, reading the tea leaves here. Some new entrants that are looking at the market and looking at owned or purchase opportunities versus leasing, because they have defined needs. So, that's a little bit of lightning striking, to be quite honest with you, but it does happen. So really, I think what we would do when we're looking at an asset that a tenant has, an owned asset, we would sit down and obviously try to provide a broker opinion of value, look at its location, and really, again, sort of go through the analysis that we do really for lease space, because you still got to look at drive times. You got to look at all the sort of analytic, or apply the analytic tools now to an owned property. So that's how we would sort of approach things with a nonprofit that owns their building, that maybe wants to sort of realize some value. In some cases, nonprofits don't want to completely move out of their building. So, you could have a sale leaseback sort of situation as well. So we do all those sort of analyses and have it transacted that way, but it's really a case by case basis.
And just to add on to John's point, I mean, the marketplace has been depressed in terms of number of sales volume. Folks who don't need to sell, a lot of times they're not selling. The things that are the worst things to be selling right now would be essentially commercial office space. But there are some bright spots in the market. So residential has not been impacted in nearly the same way. And in a weird way, folks were thinking so much about their homes and their home environment during the pandemic that there's been actually a surge in home buyers, especially those that are outside of the central business district of cities. So they're actually for residential potential development sites, as well as last mile industrial sites. Those are actually good times to be selling.
Great, thanks. And that reminds me of one final audience question, unless something comes through, is during the overview of the DC market, attendee noticed that we didn't discuss the eastern quadrants of the city, northeast and southeast. Do you have any kind of high-level observations about what's going on in terms of real estate opportunities in those quadrants for folks who are already located there or want to move into those areas, and how that's changed during this COVID period? Yeah, thanks.
Yeah, so I would just say we try to be inclusive as possible here. Yeah, the southeast market's interesting because it's generally still although you're seeing some private tenants moving into that market, down by the ballpark. Obviously, the Wharf project has brought in, and we've represented clients there. That's mainly private sector tenants. But those markets, and I'm talking specifically about the ballpark area, the riverfront capital bid, is generally still a GSA market because of the Department of Transportation, the Naval Yard, and what have you. But that's changing. So clearly we can provide this analysis down there as well. But I would say, much of what we discussed today is applicable in those markets as well. In terms of Northeast, again, we've seen heavy development up in that market and what have you. But I would say, obviously, the vacancy rates have continued to increase up there as well. So I think what we talked about today, just in the general, overview of the market, it would apply to those markets as well. They're a little bit different because those are emerging. We call them the emerging markets of DC. But again, high vacancy rates. I think great tenant leverage in each one of those markets.
Excellent, thank you. And with that, we're going to end today's webinar. I want to thank Stephen, John, and Aaron again so much from Transwestern for sharing their expertise and answering our audience questions. So many practical and specific things to think about, especially around remote work and COVID. I know I learned a lot, and also a great high-level overview of the DC market and how to strategically assess your real estate needs that I think nonprofits are thinking about all the time. So again, thank you so much for a wonderful presentation and for participating with us today.
Thank you, Jason. We appreciate it.
Really
Thank you.
appreciate it. And we
Awesome.
do be a resource, so please, if there's something specific you want us to help think through, feel free to reach out.
Wonderful, and same with us at the Pro Bono Center. If you have legal questions around real estate, around landlord-tenant issues, or around, as we mentioned earlier, maybe employment law issues that come out of these decisions, always feel free to reach out to us. Our website is probono.center/nonprofits, where you can find contact information and also our library of online resources. With that, thank you again for joining us today. Enjoy the rest of your day.
Thank you.
Bye, everyone.